Hi everybody, and welcome to today's webinar, which is strategically timed because we're not only at the start of a new financial year, but it feels like we're entering new territory with changes in the broader economic environment and the property markets. I'm Terry Ryder, founder of hotspotting.com.au. My special guest presenter today is multi-award-winning buyer's agent and best-selling author, Miriam Sankula of Property Migrants. Today's discussion is happening at a time of disruption in residential property markets. Much has changed in real estate since the start of 2022. And now more than ever, real estate consumers need access to good information and quality analysis. And let's face it, you're not going to get that from mainstream media. The best place to go, I believe, is to find out what's really happening in real estate markets is to speak to an experienced and highly credentialed professional who's at the coalface of the property market every day. And we have that person with us today, Miriam Sankula of Property Mavens. Welcome.
Thank you, Terry. Great to be here.
So, yeah, a brave new world has presented itself in 2022. I think that some real estate consumers at least are finding it a bit confronting, but we're hopefully today going to put a little bit of common sense into the discussion and let people know what's going on, that the world is not ending.
True, and it's a bit of a shake-up, not just for consumers, but it's also a shake-up for the real estate industry. Those agents or advocates who've had it easy and have ridden a high, strong market are now having a reality check, and I don't doubt a lot of them will be coming out of business as a result.
Okay. Well, you've got a presentation for us today, so why don't we just get straight into that and also make people out there watching and listening aware that you will be able to give us your questions, which you can do by typing into the chat box or the Q&A panel. And towards the end of the presentation, we will deal with as many of those as we can.
Absolutely, and there are also some offers and resources at the end of the presentation available for everyone as well. So the usual disclaimer, just note throughout the presentation, we're not providing any tailored financial, tax, legal or property advice, and we do strongly recommend that you seek your own independent accounting, legal, finance and property advice from an expert before embarking on a decision. So what are we going to cover today? Well, it's all about what's going on in the new financial year. Between 2022 going into 2023, there's uncertainty that people are suffering from. It's about what lies ahead, talking about metro versus regional, vacancy rates and rental prices, and building new versus established. So a little bit about who we are first. So we are a property advocacy agency. Our expertise is buyer advocacy, where we buy high-performing properties for clients that outperform the market. We help people find the right property with the right attributes for the right price, and we secure the right result. So basically, we're working for Australians of all ages, helping them buy and sell real estate to accomplish their goals and objectives. And as Terry said, we are a multi-award-winning industry recognised firm. And I'm proud to say I've just received my 20th finalist nomination over the last 10 years. So pretty proud of that. And that's very, very rare in my industry. From a vendor advocacy point of view, again, we're helping our clients sell property so they can also seamlessly move on to the next stage of their lives. And a little bit about me. So I am a licensed real estate agent. I've had 25 years in the industry working as a buyer and vendor advocate. I'm an accredited property investment advisor. As Terry said, a best-selling author. My book, Property Prosperity, is available, I think, on Amazon for about $4.99. So I highly recommend everyone read it. Best-selling author, media commentator. I've recently been an expert witness against what I call fake buyer agents. These are advocates coming into the market with no real training or experience, and unfortunately, they're not doing the right thing by their clients. And I'm the 2021 REIB Buyer's Agent of the Year. So what's next for property in 2023? Well, much has changed in the last 12 months. We've transitioned from a nationwide boom to segmented markets, with some rising strongly, others rising moderately, a few stagnating, and some are falling after years of noticeable growth. So as we approach the new financial year, what next for real estate? So answering the core question requires basically some sophisticated analysis, and the shallow sensationalistic treatment in the mainstream media is what I'm sure you, Terry, would also caution people against. So we're entering a new era where regional differences will be profound. Vacancy rates and rents will define markets more so than prices. Markets that offer relative affordability will be the leaders. The return of overseas migrants and students will also change some markets. Economic and share market volatility will draw more investors to real estate, and major infrastructure generating events will also have a big influence. Now, obviously, we've had a degree of uncertainty and there have been multiple factors that have contributed to that. So Australia in particularly, we've got different states dealing with massive and repeat floods. We've had bushfires in recent years. We've had massive inflation across areas such as food, fuel and energy, largely driven by the war as well as some of that flooding. There have been stock market volatility, and people's faith in real estate is now starting to increase. And as we know, when markets are volatile, historically, people move to bricks and mortar. But we also know that the media is breeding fear. So it's really important that you do research. Whatever you decide to do, you do research, make fully informed evidence-based decisions. Sometimes it's not a bad idea to zag when others are zigging, or vice versa. And fortune does favour the brave, providing you are making educated decisions. So just keep that in the back of your mind. All right, so what to for 2023? Well, of course, we've had the media talking about potential recessions, but the RBA and government are predicting a soft landing. They are forecasting a slowdown in growth, but definitely not a recession. And if we look at what's been going on, well, obviously key factors to watch out for are inflation. So Australian inflation is estimated to peak at 6.5% to 7% by the end of 2022, and then recede back to its target range of 2% to 3% by the end of 2023. Obviously, it's a key driver of interest rates, and it actually robs people of purchasing power. In the past, central banks have often ratcheted up the interest rates too hard and brought out a recession as a result. So we can see here on this graph that inflation is actually really has gone through the roof and not behaved this way, and you know, since basically 2002 to 2007. There are global factors to take into consideration. So US inflation tends to influence inflation outcomes worldwide. US inflation is currently tracking at 7%, and it's a little bit of the old adage, when the USA sneezes, the rest of the world catches a cold. We've also got China in the mix, and they've been unable to control COVID, and this has led to lockdowns and falling economic growth, which is bad news for Australia because obviously they're our biggest trading partner. And then, of course, the war in Ukraine is one of the principal drivers of world inflation at the moment, and peace in the Ukraine should moderate energy and food price inflation worldwide. So the sooner the better in terms of that, the war coming to an end and peace being found, because that will benefit basically everyone around the globe. So what lies ahead? Well, realistically, will a doomsday happen? And it's highly unlikely that the answer is no. The major banks are forecasting around a 15% reduction in residential property prices nationally over 22 to 23 financial year. And it's important to note that is Australia-wide. And we certainly still believe that prices for selected property types, i.e. investment grade property, across certain suburbs, particularly in Melbourne, will contract by around 5 to 7% before rebounding strongly in the next upcycle. And the key factors to watch out for in terms of actual market performance and inflation and employment outcomes as well. So the employment numbers, excuse me, are currently very strong, with low unemployment and falling underemployment. And the rise in interest rates is likely to stem this trend. During the early 1990s, it was unemployment which drove the property slump. And one red flag to watch out for is unemployment of the tradie types. When these people are struggling to find work, then the broader market also tends to struggle. All right, so if we look at national credit levels, you can see that they've just started to really come off the boil up here for home buyers or the owner-occupier market. And they're still sort of got the same trajectory for investors, and this has been over a period of time. Now, mortgage stress, especially in suburbs with high average debt loads and low equity in housing, will become worse as rates rise, and this will lead to greater falls and subdued uplift in the next upcycle. Then we need to talk about, obviously, the fundamentals of supply and demand. A falling population growth has dented demand and looks like it to be reversed with immigration bouncing back, but this will probably take 2 to 3 years for it to actually be evident in the market. Interest rates have increased by 1.25% in 3 months, and there are further increases expected in coming months. So the cost of borrowed money is obviously a key driver in property demand. With rates rising from historic lows, this looks likely to dent demand and negatively impact sentiment. Economists on average expect the cash rate to rise from 1.35% now to 2.6%. Implying a mortgage rate around 4.9% over the next 6 months. Now, Terry, we were talking about the fact that it wasn't that long ago that the RBA was saying they didn't expect interest rates to increase for a couple of years, wasn't it?
Absolutely. And I'm constantly asked by people what I think will happen with interest rates, how high they will go, etc. And my response is, really, I have no idea. The people actually make the decisions have very little idea. And it was as recently as January this year that they were still saying that there'll be no interest rate rises in 2022 and probably not before 2024. And a few months later, they were actually lifting the official cash rate. And they've now done it 3 times, and not just by 1/4%, but by 0.5% twice. So it's very hard for the average consumer to get any real handle on what will happen with the level of interest rates when the people actually make the decisions apparently don't know too much themselves. But I think, I think people have a risk of overreacting to the impact of rising interest rates. The media certainly has. I think there are a number of buffers in the system which are kind of muting the impact for many households. Many people are already paying more than they needed to. So the interest rate rises don't necessarily mean they're going to be paying more in their monthly repayments, because they never decreased them back in the day when they were able to. When interest rates are falling, you actually have to ask the bank to reduce your repayments if you want them to, and many people didn't. So the other factor that probably needs to be taken into account for people borrowing to buy property is that the interest rate rises primarily apply to existing mortgages, but new business banks and the second tier lenders are competing very strongly for your business and will probably provide you with discounted interest rates. So you're not necessarily going to be paying interest rates at the new high level as a new borrower to buy another piece of real estate. So that needs to be taken into account.
And obviously anyone who's had the benefit of paying low rates, just remember that the banks will have assessed your serviceability and capacity to wear any increases. So, have some peace of mind that if the banks have given you the money, they've built that into it. It just means you've really got to adjust potentially your lifestyle accordingly. But certainly if interest rates were to rise more than 1% more than market expectation, that can cut into the property market and create bad outcomes. But obviously the impact of that is top of mind with the RBA and the federal government. So then if we talk about supply and demand having an impact in the market, well, the rebound of new property development is slowing now, and it's likely to continue falling over the next 6 to 12 months. And a lot of that's got to do with obviously the cost of building rising and fixed contracts no longer being viable for a lot of builders. The most impacted sectors that are likely to be affected are going to be your urban fringe detached housing type of property, followed by high-rise, inner city high-rise markets. Things like new infill and smaller unit developments in middle suburbs are likely to continue with more or less the same pace because they will continue in their demand. But as I said, building materials and trade labour costs have caught construction companies by surprise. And they've been the real wild card in terms of the supply of new property, and material costs have risen in some places between 15 to 27% just over the last 12 months alone, which is just crazy. So let's talk metro versus regional. We've had a very strong regional boom over recent years, and it's been driven by internal migration and a boom of investors buying for the short stay accommodation market. Plus, there's been a slow uptake in property development in regional areas as well. So we believe the phenomenon will continue over the next year. It will moderate though, and growth will start receding in centres probably within 2 hours drive of capital city. So it's important that you want to invest or buy in areas where there's a substantial population of minimum 50,000, but ideally 80 to 100,000, and a very diverse economy from a growth driver perspective. Certainly metro areas, especially Melbourne and Perth, they're likely to be best placed to weather any downturn. And capitals will re-emerge in the next upcycle as the best performing markets. And this is largely due to Melbourne and Perth doing potentially better than some of the other states because we've had lower price increases than Sydney, for example. So you can see here when we look at changes to the dwelling prices between March 20 to June 22, that the standouts have been regional Tasmania, New South Wales, and followed closely by Victoria. So, you know, that's pretty significant, 50% capital growth in the space of just over 2 years in some areas. And then conversely, you can see obviously Brisbane's performed incredibly well, Hobart, Canberra, and then lower percentages around Melbourne and Sydney, but obviously coming off a significantly higher base as well. If we have a look at the regional price growth, there has been a slowdown in price growth since the middle of last year, with prices falling over the last 3 months. Queensland and New South Wales are actually mirroring each other in terms of that performance. And the desire to move is not as strong as it was last year. Life is certainly coming back to more of a normal existence in Melbourne and Sydney. And certainly the cost of buying regionally is less affordable now for first home buyers than it was pre-COVID-19. So we're starting to see some softening there. Properties are still selling. Maybe you don't have as many offers as you did previously or as many buyers, and vendors definitely have to wrap their heads around prices softening as well. And you can see here too, from a regional growth perspective, that there's actually already been a drop in some markets from a metro point of view. And then if you have a look at the regional areas, some slight dropping in regional Victoria, a little bit in regional Queensland, and a little bit in regional WA. So if I talk about the best opportunities in Victoria, well, certainly you want to factor in the basics. So growth drivers being one of them. So we believe that growth will still stall in our targeted suburbs or areas in targeted suburbs within Geelong, Ballarat and Bendigo before experiencing a solid rebound in the next cycle. You have to be conscious of buying investment grade properties. So you don't want poorly selected property in marginal suburbs, as those markets will have a tough time. So watch out for poor quality stock hitting the market, be selective, and vendors' expectations are also very high. So they're going to have to adjust their expectations too. And then very much in Victoria, we've got the Victorian Commonwealth Games boom coming in 2026. So that'll enable lots of job opportunities, infrastructure spend, hospitality and local amenity. So this will happen across regional Victoria, and obviously the biggest impact will be in the best regional markets being Geelong, Ballarat and Bendigo. So that's definitely something for investors to still take into consideration to invest in those markets. From a metro point of view, I mentioned about Perth and Melbourne likely to weather any downturn, and only really Adelaide's not feeling a downturn in their interest to date, and that's largely due to the relative affordability. But Melbourne, we do still have high activity in affordable areas, particularly around that $600,000 price point. Melbourne has been performing better than Sydney, and it's likely to come off, it started to come off a bit in the second half of 2021 and of course the March quarter this year. And certainly the top end of the market is weaker. So there's been a significant fall at that top price point. Places like Stonington and Glenara have fallen off, and areas where there's high density apartments and developments too. And no doubt it's going to be weaker at the top end in Sydney and places like the northern beaches and eastern suburbs as well. So a little bit about Melbourne. Well, price rises for Melbourne in the metro areas, whilst historically large, have been less than Sydney and regional hot zones in New South Wales and Queensland. It's expected to decline in prices over the next 12 months, and it's likely to be more moderate in regional areas in all capitals, again, except Perth and Adelaide. And affordability is really an issue as well. So properties that have got high amenity, that are well serviced, inner and middle ring suburbs feature strongly amongst our best outperform locations, and trophy homes in small undifferentiated high-rise units and urban fringe housing are worst placed. So keep an eye out for 3-bedroom houses. So you want a decent block size, you want something that's family friendly and in the middle ring suburbs. The The best opportunities for investors are in that price bracket between 650 to 1.1 million. The best location for houses in Melbourne Metro are Kingsville, Bentley, Keilor East, Cheltenham, Forest Hill and Blackburn. The best locations for townhouses are inner middle suburbs, and just make sure you've got some decent outdoor space in terms of the courtyard. And for apartments, those 20th century complexes with strong fundamentals for capital growth. So small size developments, ideally you're wanting a courtyard or a balcony, and ideally you want off-street parking as well. Best locations for units, again in Melbourne, are Elstonwick, Essendon, Fairfield and Hawthorn East. So let's talk about vacancy rates and rent prices. So Melbourne's vacancy rates have been shrinking for the last 2 years. They're now back around 2% from a peak of 4%. And in 2022, the asking rents have recovered pretty well all of their decline and are looking set to start rising. So there is potential for an asking rents boom, and that's due mainly to the increasing number of short stay accommodation properties in and around central Melbourne. Terry, have you been finding that's been an issue in Queensland, like the number of investors that are getting into real estate, but they don't want to rent them residentially, they specifically want to use them for short stay?
Excuse me. Look, it is an issue. I think it's part of the issue. I don't think it's the major part of the issue. Brisbane City Council thinks it is because they've announced that they're introducing outrageously high rate increases for investors who own property that are used for short-term rentals like Airbnb type uses. I personally think it's just a cash grab, and they're trying to justify it by claiming that they're trying to address the shortage of rental properties. I don't think it's the major part of the problem. I think we've ended up with a nationwide rental shortage crisis, and I think it really does deserve the word crisis, which tends to be overused, particularly in media, but I think it is a crisis because vacancies are so low right across the country and it's causing rents to rise. But we've arrived at it because there have been so many decisions in the past 5 years by all levels of government and also by some of the regulatory authorities like APRA, which have discouraged property investors, and there's been more investors selling than buying in recent years. And so gradually the pool of rental properties has diminished to the point where we're at now. And there's no solution in sight. None of the politicians at any level of government have a solution to this problem.
Well, that's exactly right. There's no federal election policies or solutions. The ALP has got a limited equity sharing scheme for first home buyer policies in place, and not even just for first home buyers, for people with low deposits. But there's also a potential social housing crisis, as we've spoken about, but their demand, the supply does in no way meet demand. And that social housing starts have been below their historical averages for the last 20 years. The Victorian government does have a policy to build 12,000 new community dwellings, and it's commenced and said it will take 6 years to complete, but there's a demand for 100,000 properties. So 1,000 is just really insignificant. And you can actually see here, you know, it's exactly what you said, Terry, it's supply and demand. Interest rate rises and servicing reassessments are stopping first time buyers getting into the market and being as active as they normally would. And therein lies the fact that there's still very strong demand for rentals. And you can see here over the last 12 months, the change, the percentage change in rents across the different cities, and then the combined capitals, and then nationally. And again, you can see the vacancy rates compared to what they were 12 months ago rather. So there's such a significant change. And, you know, I just end up hearing stories of more and more people that are employed, they're professionals, but they're sleeping in the car because they just can't get accommodation. It's really quite shocking. The governments of both federally and state have really let people down. And then, of course, we've got the flooding crisis and 42,000 people, you know, in one area having to relocate and find somewhere to live. It's just so hard to wrap your head around. I just really feel for anyone in that position. It's terrible.
And it's going to get worse before it gets better, unfortunately, because firstly, there's no government policies at any level of government to deal with it. Construction of new dwellings is being impaired and delayed by the problems in the construction industry with shortages of everything and rising costs. The opening of international borders is bringing new demand to the market. And the other point that you just mentioned, the floods in so many parts of Australia bring even more pressure, short term perhaps, on demand for rental property. So it's just an accumulation of factors, which means that this problem is already dire, but it's going to get worse before it can improve. And government's decided we'll build some new social housing. Well, that's going to take years to happen. We need a solution now. And the only way they can really solve it is actually introduce incentives to property investors rather than the discouragement that we've seen over the past 4 or 5 years.
Yeah, it's really bad that governments continue to treat investors like they're evil. You know, when investors are the ones holding up the market in terms of making accommodation available to those who otherwise can't buy their own property. What I'd really love to see is someone like an Airbnb putting an opportunity to rent a room to someone who needs emergency accommodation, you know, rather than charging for it. If they had a section, I know they did something around the war in the Ukraine where they were donating money, but if they just had a category of emergency accommodation required, and people, you know, we have so many people living in houses of one person occupying a 3-bedroom house. You know, if there was capacity for someone to make a room available to someone from an emergency accommodation point of view, that would make an instant difference. And I think a lot of Aussies, being as generous as they are, would open up their homes to people that are in desperate need.
But probably the bottom line here, Miriam, is why we're representing this as a national crisis, and it is from the viewpoint of people who are looking for rental accommodation, and we do have people sleeping in cars and tents and caravans. But from the viewpoint of investor buyers, it is an opportunity. It's an opportunity to get into the market, do something that's socially beneficial, but at the same time benefiting as an investor because demand is very high and rents are rising.
Absolutely. And look, I've got an example. I personally own a property where it's a 3-bedroom, 2-bathroom with an independent studio all under one roof. And I do have a lady in that studio. She's been there for a number of years, and I charge her an affordable amount of rent. And every time someone comes into the other section of the property, it's on the basis that they know and understand she's there. They all have to agree to share the costs of running the whole house collectively. But I leave her there because she's got nowhere else to go. You know, I don't, my agenda is to make sure there's always other people coming into the house who are willing to share those bills, even though they pay their rents separately and independently, because otherwise she'll be homeless. So I think if anyone's got the capacity to provide affordable housing, I've certainly bought property for clients who are beautiful people who just wanted to add it to the affordable housing pool. It wasn't about rent and returns and yields for them. They just wanted to do something charitable. So if anyone has the possibility of making a property like that available, then by all means, you know, talk to a property manager or someone who can help you structure that so you're in a position to be able to do it. Just briefly, I'll touch about what's going on for home buyers. So the regional boom has been driven by internal migration, as we know, plus the boom of investors, but we've had a lot of first home buyers going into regional areas as well from an affordability point of view. So there's still an interest there. Maybe it's not as affordable as it was, but certainly with investors, definitely you want to still be considering regional areas. There are still some opportunities to earn reasonable yields, maybe not as high or as positively cash flowed as there have been recently, but anyone with, you know, 600,000, depending on where you're looking, you know, you should be able to get something, whether it's a really good 1-bedroom unit to a 3-bedroom house. Yields are probably running closer to the 4% mark. Years ago, it might have been 7 or 8, but it's a totally different market now with the levels of capital growth. Yields haven't necessarily kept up. But over the long term, with the right growth drivers, there are still opportunities to buy and invest regionally. But you do want to take into consideration the state government legislation and reforms. So some examples would be Victoria. These came in March 2021. And there are 14 minimum rental standards that have to be met, and these can be incredibly costly, and that's why certainly we had a period of time where there's a lot of rental stock coming into the market because landlords could simply just not afford to make the changes that were required. And this is an example, this little image here. So that property that I spoke about that had the independent studio and the 3-bedroom house, that property has got 2 kitchens. In each instance, I had to get the exhaust fan raised by 10 centimetres. You can see it here. And that cost me $900 per kitchen to do so, which made it compliant based on current regulations, which weren't in play when the property was built and renovated a long time ago. So this is where some of the stupidity around the decision-making of governments has forced people who couldn't afford to do those changes to put their property out of the pool. And it's had the reverse effect of, you know, from an affordable housing point of view. Queensland, there are new reforms coming in from October 22. These include the removal of the right for property owners to end a periodic tenancy by simply providing notice. And the risk there is it could be a never-ending tenancy if they don't transition periodic tenancies to fixed-term tenancies ahead of the law. So anyone who's investing in or has invested in Queensland, really take that into account. New South Wales, there were also new reforms as at March 2022, and there were 7 minimal standards. And again, there are domestic violence residential tenancy laws in December too, where someone can end their fixed term or periodic tenancy immediately without penalty with evidence of domestic violence and the need to do so, which is amazing for someone who's in that situation where they can escape without penalty. But obviously that's just a factor that landlords need to take into consideration. So do your research, make sure, you know, if you're doing buying yourself or you're working with a buyer's advocate, make sure that they're up with what all those regulations are and they're checking them for you. So Terry, building new versus established, well, you touched on it before. There's so much uncertainty for investors on home buyers around quoted versus actual build costs at the moment. The impact of migrants and internal students coming back into the country are yet to play out. From a migration point of view, there's been a rebound of all migrant types, including overseas students. And to date, they've only recovered about 45% of the numbers that we had in 2019. There tends to be a lag of around 2 to 3 years from arrival to impact on property prices. So as we're seeing more immigrants come in, those prices increases will hit around that time. So it will have a positive impact on house prices, and that should show around 2025, 2026. And then, of course, if any of those immigrants are going to those regional areas where we've got Geelong and Ballarat and Bendigo, particularly in Victoria with the Com Games, well, then that will continue to drive growth there. But the biggest issue, as you mentioned, Terry, in established markets here, this is showing that costs of materials have gone up 15.4% over the year nationally, plus the cost of trades on top of that. In some quotes, it's showing 27-30% higher than what a quote might have been 6 months earlier. What that's doing in the market that I've been seeing pretty well straight away from when this happened, and what I've been advising my clients, is it's better and more affordable to buy properties that are already renovated, that don't need anything, maybe some very basic cosmetics. But as soon as you want to look for a property that requires any kind of structural renovation, or it's a knockdown and a rebuild, you know, you need to expect to hang on to that property for a very long time before trades are available and it's cost effective to do so. And I've seen some insane prices being paid for fully renovated properties where you've had multiple downsizes on it. They've been fortunate enough to sell, they're cashed up, and they've just paid insane prices for the privilege of buying, you know, the appropriate property that's fully decked out with nothing to do. So I think that's going to be with us for a long time. Definitely in the established market, properties that need little to no work will be the highest in demand. People will pay premium, will need to pay premium for those. Otherwise, you're just going to have to sit and wait and renovate down the track as and when you can afford to do so, and as and when the cost of materials and labour is more affordable. Terry, anything you want to add to that before we move on to questions?
Yeah, look, just in terms of the issue of construction costs, which is a big issue at the moment, it's causing all sorts of problems. In my view, most if not all the problems that the property markets face, including the current shortage, they're all caused by political decisions without thinking through consequences. So we had the federal government, for example, making this wonderful grant available to encourage people to get out there and build new houses, but they didn't think beyond the press conference, didn't ask the question, if this policy is successful, as we hope it will there be enough bricks and will there be enough bricklayers? And the answer, as it turns out, is no, there's not. There's a massive shortage, and it's been exacerbated by the impacts of COVID and all the disruption to supply chains. Yeah. So we have a massive problem where builders are going broke, as some of the bodies that represent builders are saying we've got a profitless building boom going on, with not just builders not making profits, but some of them going broke because of the situation. So another problem caused by politicians with short-term horizons and tunnel vision, and no clear solution in sight. So but again, the bottom line is that it is, despite all the issues in the industry, it's a good time to be certainly an investor owner. because of the equation which says that vacancies are as low as they've ever been and rents are rising with no solution in sight that's likely to change that situation for the next few years.
Yeah, and to add to that, Terry, and it was really interesting a few years ago when we had all the bushfires, I know I was pitching a story to the media around the fact that a number of plantations had been burnt who provided timber for construction, and that they had a window of time that they had to harvest what they had so they could season the timber before it all started to die. But back then is when the beginning of the materials cost explosion was starting, but the media weren't interested because it wasn't a story that had happened. It was only the possibility that it might happen down the track. And then, of course, we've had flooding, war and COVID and everything else on top of that. So, yeah, it's just, it's unfortunate that through a combination of natural disasters and as you've said, short-term shoot from the hip political decisions designed to attract votes rather than genuinely help people, because most of the time those decisions blow up in the consumer's face. And governments don't take responsibility for it. And, you know, here we are several years later in what is, you know, a time that I'm sure none of us have ever seen, a culmination of all these events happening all at the same time in terms of what everyone's dealing with in the market today.
So before we go to questions, I just want to touch on the subject of the apartment market. You touched on it briefly. But what we've seen in this the past 2 years, when we've seen price escalation in many parts of Australia, we're seeing the gap widening between the median price for houses, the median price for apartments in most of our major cities. And I get the feeling that we're going to see a period where more and more people are going to be targeting apartments, both for affordability and lifestyle reasons. Do you think that, do you see evidence that is happening?
Yeah, absolutely. Definitely. So during COVID, there were a lot of short stay accommodation and accommodation that was particularly being rented to students in the city. And a lot of those ended up vacant for a very long time, and people consequently couldn't afford to hold them or chose not to. They got sold. There are a number of downsizes and tree changes and sea changes who've sold their suburban house, bought a CBD apartment, bought their lifestyle block. And so that stock has been absorbed and absorbed quite quickly. There's very much still demand for apartments now, and there's more competition from a pricing point of view than I've seen in recent years as well. So the downsize of tree change, sea change market will keep seeking those types of city pads because they lock up and leave. And then, of course, you've got first home buyers moving into those markets as well if they're priced out of suburban areas or they choose to be in there from a lifestyle point of view. But we still very much have issues with cladding, combustible cladding, and all the problems that we had during the building boom when governments didn't adequately check what was being done, and buildings were signed off being compliant when they obviously weren't. So they are still problematic. There's still a lot of risk factors associated with buying apartments, and it's not for the faint-hearted. And it's really important that if people are going to buy apartments, they're looking at meeting minutes, they're talking to owner corporations. I've gone blank there for a minute, but they're really doing their research and their due diligence, because you don't want to buy a property that's got a bit of a lemon attached to it, which means you'll struggle to resell it, or you'll resell it and you'll lose money on it. And I'm coming across properties now, even when people bought them 5 years ago off the plan, of course they would have overpaid at the time, and the market's only willing to pay them what they bought now, what they paid 5 years ago. And it could still be a good market, but that's the other thing that, you know, anyone trying to get out of the real estate apartment market, if they bought off the plan or if they bought during a booming market, they may need to adjust their price expectations, because fundamentally, you know, if it's a large development with hundreds and hundreds of apartments, it doesn't mean it's performed well in the last few years just because the rest of the market has as well.
There's an awful lot of very generic apartment developments out there. Is it the case that people making the choice to go for apartments, whether it's home buyers or investors, need to perhaps look for something with a point of difference, something with character that's going to distinguish it and give it a better chance of achieving some growth?
Yeah, absolutely. And that's what I was saying, you know, if you want to buy in an area where you can buy an established 20th century apartment that's built in the 20th century, that's probably a larger size internally, because, you know, properties built 20, 30, 40 years ago have always got bigger floor plans than properties built in recent years, unless you're starting to get up to that $1 million price point, you're getting a 100 square metre property as a result. So again, it comes down to your budget, but regardless, you know, there are some good opportunities in newer buildings and smaller buildings, so long as they're well placed they've got relatively affordable owners corp fees. I'm seeing some owners corp fees you're running at 5K a year plus another 2K for rates. So, buyers are 7.5K out of pocket just to step their foot in the door. And that's year after year after year after year without necessarily any indication of those costs going down, particularly in larger buildings where you've got lifts and full-time security and all of that. So you really just have to look at the costs of holding these properties on an annual basis. Even if the price seems attractive, just understand that's an ongoing cost that you'll never be able to eliminate. And you've got to be able to cash flow that regardless of your circumstances. Things like pools and gyms as well, you don't want to be investing in those sorts of developments because they cost a fortune to run, and that'll be reflected in your owner's corp fees. But certainly investors, you want your point of difference being around local amenity. You want to basically have a courtyard or a balcony. You want your off-street parking. You want to be near public transport. You want to be in areas where there's high demand and low supply.
Okay. Just poking around, doing some research on the Melbourne market recently and comparing prices for houses, typical prices, median prices in certain suburbs with median prices for apartments. Some places stood out where typical apartments were less than half the price of typical houses, in some cases a third. You mentioned some of your better suburbs in Melbourne to buy included, I think, Hawthorn, or was it Hawthorn East? And I thought that was a case in point. Wonderful location, trendy, inner city, and typical apartments just so much cheaper than houses. Is that something that people could say, well, here's an opportunity to buy in a great area, but at a price I can actually afford by opting for a good apartment?
Yeah, absolutely. And where you do have suburbs that people just simply cannot afford to get into the suburb because the land value is so high, that's why the option of an apartment in that area is equally as attractive. So, places like St Kilda, Western Kilda, Albert Park, Middle Park, you're talking about minimum 1.3, 1.4, 1.5 to buy a townhouse in those areas. So if you have the capacity to buy an apartment for a bit less, you're getting amazing location. Having said that, downsizers buying small boutique apartments in those suburbs are still paying around that 1.3, 1.4, 1.5 anyway. But yeah, it's all relative obviously to the suburb that you're looking at. But if you can buy in a suburb with very high land value, but there aren't a lot of units or apartments in that area, that's your sort of scarce opportunity that's well worth considering, notwithstanding you've still got to do all your normal research.
Okay. Well, perhaps we could turn to some of the questions that people are putting in the chat box and the Q&A, and encourage you to type your questions in. We've got 15 or 20 minutes left on the broadcast, so we'll do our best to answer as many questions as we can. And I'd like to start with one with James, because I get asked a lot of questions in the various forums that I speak in, where people think they're asking a question to which there is a right answer. And my response, which sometimes might appear to be an evasion, is that the answer depends on you, the individual. Where's the best place to buy? Well, it depends on you. So James is asking, in his circumstances, with a $600,000 loan approved, looking for a good level of capital gain in the next 5 years, where's the best place to buy? My response would be, I need to know more about you before I can give you an answer. Would you agree with that?
Oh, always. It always comes down to your own personal situation. What's your job? What's your job security? What's your goal? What's your time frame? What are you trying to achieve? Have you reverse engineered that? What's your risk profile? What's your borrowing capacity? I think I can see a question here. James is basically wanting 30% capital growth in 5 years and wants to know where he can get that. Well, you've got to factor all of those things in advance to start with. And then, of course, it comes down to doing the research and looking at the growth drivers in each of those states that you're looking at, and then drilling it down to the capital cities in those states that you're drilling at. I mean, if I look at WA did nothing for probably about 9 or 10 years. And it's only in the last 2 or 3 years with COVID that there's been a massive influx of expats coming back home, and prices have finally sort of caught up to what they maybe were 12 years ago. So the market's trying to, finally getting back to where it was. Then you've got different price points that have performed incredibly differently in Perth around the same time as well. So it's not that simple. If it was that simple and that easy, everyone would be making money and everyone would be making their 30% capital growth. So simplistic questions don't result in simple answers. You have to do the work, or you have to work with an expert who can give you guidance on what to look for, what to consider, and what to take into account, particularly if you want to build a portfolio. And what I always say to clients is I'd rather help you get 3 high-performing investment grade properties that outperform the market rather than 6 average performers, because with each property comes land tax, property management fees, tenant issues, maintenance issues, rates, accounting fees, and all the rest of it. So don't think of it in terms of how many properties you want. Look at it in terms of, well, what's my end goal? What am I trying to achieve? What's my capacity? And then reverse engineer and move forward from there. But I've written about a lot of this in my book, Property Prosperity, which you can download off Amazon for like $4, $5. So definitely have a read through those different chapters, and that'll give you a little bit more to think about, James.
Okay, and I would urge everybody who's watching and listening that if you have a question like that, now what should I do? How should I invest? Where should I buy? I'd urge you to make contact with Miriam and talk about your situation, because that's where you might start to get some answers, when you can have that discussion with an acknowledged expert. And but it's all the answer will depend on your situation and what your goals are, etc. There is a question about. Suddenly, where is it? Keita is asking your opinion on greenfield sites around Melbourne, for example, Point Cook. Now we're talking about suburb down in the far south west of the Melbourne metro area, heading towards Geelong.
So Point Cook's a really interesting one, because Point Cook's maybe only 20, 25 k's out of Melbourne, but it's a 2-hour commute from Point Cook into the city each way each day, because there's no direct train line to the CBD. So people have to rely on the buses and they have to rely on the freeway. And pre-COVID, it was actually a nightmare for people to commute from Point Cook into the city for work. In terms of greenfield sites, well, I'm sure, developers are desperate to sell land, but what's the point of trying to land bank if you can't build a property on there? And what's the purpose of the purchase in the first place? Is it a home that you're looking at buying and eventually building, or is it for investment purposes? Because generally, as a rule of thumb, I don't think house and land packages are great. You don't want to invest for tax benefits or depreciation. You want to invest for capital growth or cash flow. And if you're investing in an area or a greenfield area where the cost of your mortgage repayment is going to be similar to the rental return, well, then anyone who could afford to buy, well, why would they bother renting from you? So I've seen people come unstuck with that before, where they've done all the right research but couldn't rent the property because it was equally as affordable to buy and build your own with the outgoings as it was what the cost of rent was going to be. So comes back to what's your purpose, owner occupier versus tenant versus investor. And then fair enough if it's owner occupier, but again, how long is it going to take you to build? What's the cost of holding that land until it is built? And then what's the cost of construction? And I go back to the comment earlier of ideally don't buy anything that needs a full renovation or a full rebuild at the moment, because there's no capacity for builders to fix their prices because it's all, going a bit crazy at the moment.
Okay. Now, Chinmay's asking whether we think Brisbane's in a position to overtake Melbourne in the near future. New infrastructure, better weather. Well, I'd certainly challenge that just lately, and potentially more employment opportunities.
Well, I'll let you throw to that one first, Terry, and then I'll come in after you on that one.
Look, I don't think Brisbane's going to overtake Melbourne, certainly not in size. I think actually the most likely scenario is that at some point in the future, Melbourne's going to overtake Sydney in terms of the size of the city. But Melbourne will continue to grow. It's a great city, and it offers a wonderful lifestyle. In my view, it's Australia's best city. If I had to live in a city, that's the one I'd choose. Brisbane's going to continue to grow. It's got great growth prospects, but I really don't think it matters too much whether it's ever going to challenge Melbourne in size. Probably not, but it is going to be a growth city for sure. It's certainly leading Australia in terms of population growth and maternal migration. Its infrastructure spend is elevated, and it's going to have to become more elevated because it's got that target of the 2032 Olympics, which will require investment in sporting facilities, transport infrastructure, etc. So a great future for Brisbane, but I think Melbourne's always going to be a big and growing city. A lot of migrants choose Melbourne over everywhere else in Australia, and that's a factor.
Yeah, and I guess I agree with you on the weather. Queensland's suffering a little bit of late, but certainly if I look at Melbourne and Sydney, they're the two largest capital cities in the country, and they've been the two largest economic centres in the country as well. And there's no reason that's going to change anytime soon. Exactly what Terry said, you know, migration to Victoria and Melbourne in particular, with a lot of immigrants coming here, and families that have been established here for, you know, 60 odd years, 70 odd years. You know, they've all sort of come out in the 50s and generation after generation. Then we've had newer immigrants coming and setting up as well. But again, infrastructure happening. At one stage, I know Victoria had more infrastructure going on than the rest of the country put together. Obviously, that's going to change over time, but we've also got the Commonwealth Games coming up, so there's going to be a burst there. So I think you've really got to, again, decide, are you buying to live, or are you buying to invest? What are the drivers that you're looking for? What's your budget? And then making decisions based on that, because equally, there are opportunities around the country, but you've just got to decide what your own investment goals are.
Yeah, a lot of people ask, a couple of people have typed in questions about the changes to Queensland land tax. I'm getting a lot of questions. It seems to have suddenly become very top of mind. It was actually announced December last year and doesn't come into effect until I think July next year. But all of a sudden, everyone's asking questions about the impact of the changes to Queensland land. Are you aware of this? Is this something that you've been?
No, I'm no longer in the Queensland market. I haven't kept up with that. What's your take on it, Terry? You're up there, you're local.
Yeah, well, firstly, I think it's outrageous. The Queensland government is making a cash grab, like state governments tend to do, and they always use the housing market as their favourite cash cow. So it's always been the case that land tax has been a state government thing, and you get charged land tax on properties, land that you own within the state of Queensland, and all the other state governments do likewise. But now Queensland's going to be trying to charge people land tax based on all their land holdings, not just the properties they own in Queensland, but they're going to aggregate properties they own elsewhere in Australia. I'm amazed that it's even legal that they can do that.
I would find it very surprising if legally they can get away with that. I would expect that there's some sort of property association or housing industry that may actually challenge the government on that.
I'm certainly hoping so, because I've seen some examples put on some of the Queensland state government websites saying here are some of the possible scenarios. And in those scenarios, the amount of land tax an individual might have to pay goes from $1,000 a year to $8,000 or $10,000 a year. And that's, you know, a huge slug. Yeah. If that was the case, then I think that would have an impact on people wanting to buy in the Queensland market as investors.
Absolutely. Any financial deterrence or costs that add to a landlord's need to service can absolutely act as a deterrent. So whether it's tenancy legislation, whether it's land tax, whether it's interest rate increases, and if it's a combination of all these happening at once, well, absolutely, people will, you know, sell up and walk. So governments need to be really careful about that. And I'm gobsmacked that there's even the capacity for them to legally do that. And I would hope that there's an organisation or a government department or someone that challenges them on that, because that's federal governments can do that. I can't possibly see how state government could do that. I'd suggest that they're operating outside their legal ability to do so.
Yeah, I certainly hope it's the case. But if you want to know why we've got this chronic rental shortage crisis in Australia, there's an example of why. This is one of the many decisions that's been made, particularly by state governments over the past 5 or 6 years, the accumulation of which is a huge disincentive to people to buy or retain investment properties, and fewer and fewer people have. And so we have a chronic shortage to which there is no near solution. Quite a few questions, Miriam, about the Perth market. You've mentioned a couple of times in your presentation. I certainly think that Perth is one of the places that people could be considering. As you mentioned, it hasn't shown a lot of growth in the last 10 years. I think the next 10 years are going to be much better for Perth. I gather you think something similar?
Yeah, absolutely. Again, it comes down to what you're buying, where you're buying, go where the employment and growth drivers are, and just treat it like any other larger capital city. Be wary of the regional areas. I mean, there are regional areas where like anywhere, you still want some basic fundamentals. Don't just rely on lifestyle growth. You know, I know Margaret River, for example, I spent 6 years living there and the market didn't necessarily perform very well at the time. And there's been a recent boom because of everyone wanting to flee the cities or relocate. Having said that, Perth still got an amazing lifestyle anyway, and Perth hasn't suffered the sort of lockdowns to the extent that, say, Melbourne has, where people have fled Melbourne or people have fled Sydney because the lockdowns have been much more severe here. So just always do your research, look at your fundamentals, make sure it's an investment grade property, and make sure you've got access to significant amenities and it's a type of property that's in demand, high demand, low supply. And yeah, talk to the local agents, see what the local market is after as well. Just do your normal research. But certainly the market has picked up significantly in Perth in a very short space of time. It's sort of back to where it was, as I said, 10, 12 years ago. And there's certainly lots of employment opportunities, and we've got mining starting up again over there as well. So yeah, just do your research and make sure you've got the right experts to help you. I know Momentum Wealth operate out of Perth and WA. They're an excellent buyers advocacy firm if anyone's looking to work with someone over there. So yeah, get some expert help, always a good idea.
And with keeping in mind that because of the subpar performance by the Perth market in the last 10 years, it's now the most affordable capital city in Australia. So it's got that in its favour, but certainly the economy has improved a lot. Vacancies are very low, rents are rising, demand is rising. Stav, you mentioned the Rockingham area. Certainly it's an affordable precinct with a number of suburbs that actually front the water, the beaches at affordable prices, very close to one of the biggest jobs nodes in all of Perth, that Queenana Industrial Commercial Precinct. So certainly got some potential. There's a question from Vicky. Miriam, do you have an opinion on the Gold Coast market at the moment?
No. No, I'm not going to venture there.
Yeah.
I know there's a lot of activity, as there is in a lot of southeast Queensland, and that's basically from obviously Noosa and the Sunshine Coast all the way down. So beyond that, you're probably in a better position to comment on it than me, Terry.
Yeah, look, the Gold Coast has actually done remarkably well as a market in the last couple of years, given that its major industry, which is international tourism, has been pretty much turned off. But because there's been demand from expats returning to Australia, wanting to buy in a lifestyle location, big city buyers fed up with repeated lockdowns have bought in the Gold Coast market. So it's been through quite a growth period. It's starting to moderate now and starting to go back to being more of a normal market. We're seeing some substantial price growth in apartments as well as houses, but I would urge people to be very cautious about the high-rise apartment market on the Gold Coast. It's performed well in the last couple of years, but long-term it hasn't, because the Gold Coast keeps having these incredible bouts of oversupply. They just keep throwing up mega towers, and quite often it can take 3, 4, 5 years for the market to absorb all that extra stock. That's certainly not the case at the moment, but I would urge, if you're going to buy in the Gold Coast market, I think you should go for houses on land in quality locations rather than apartments and the generic high-rise.
And just make sure that if you are going to look at high-rise apartments, that they're primarily owner-occupied rather than investors, and you've got views that won't be built out.
Yeah. There are, as always, more questions than we have time to answer, but we're just coming up to the hour, and Miriam, I think perhaps we should end on a special offer that you're making today, and also some details about how people can follow up and contact you should they wish to do so.
Oh, absolutely. So on the website here, where you can see that little red circle, there's an opportunity to download some free resources. In terms of who we are, we help clients who are buying and selling. So we work with clients in metro and regional markets in Victoria. So we work with first home buyers, upgraders, downsizers and investors. If you want help selling or buying, you can contact us and just fill in the box for a free consultation. So we're happy to assist you in terms of giving you some guidance around maybe what we can do for you. As I said, there are plenty of free resources. So if you click on the resource button and click on our home buyer guides, you'll see the 7 common mistakes investors make and home buyers make and self-managed super fund investors make. Bit of a quick plug for my book. As I said, under resources, you can actually buy a hard copy, which I'm happy to autograph for you. Or if you click this green link here, you can buy it on Kindle. As I said, it's $4.99. It's a really easy 3-hour read. I've written it for people who are new to the Australian property market, who are relatively new investors, and even experienced investors where you don't know what's gone wrong, you can't pinpoint it, you might learn something in the book. So I'd encourage you to download that. Again, beware of the smoke and mirrors. In recent years, we've had a massive boom of what I call fake buyer agents entering the market. They've either come in with no experience or they're ex-selling agents who've never learnt how to be an advocate. And by that, I mean they've never unlearned how to be a selling agent and then actually been properly trained to be an advocate, because they're two totally different ways of operating. I've got a really good article under my blog section called The Rise of Fake Buyer Agents, What You Need to Know. So just be aware of anyone who's a double agent trying to get money on both sides of a transaction, anyone who's got little to no experience in the real estate industry selling real estate. Make sure whoever you deal with is licensed with the Real Estate Institute Association in the state you're buying in. You want them to be a member of REBA, the Real Estate Buyers Agents Association as well. As I said, minimum 2 years experience, and by all means have a read of that article. That'll tell you what to look out for. Having said that, we are recruiting experienced advocates into the business in Victoria. So we're looking for new team members to partner with us in Property Mavens. So feel free to reach out for me if you're an experienced agent or buyer's advocate and you'd like to have a chat. And then, of course, these are my contact details for anyone who wants to reach out and connect, whether it's on LinkedIn, Facebook. You've got a property question, you need a referral to a good advocate interstate, whatever the case may be, happy to help you.
Okay, we'll just leave that on the screen just as we wrap it up, Miriam. So I would urge people who have further questions. We didn't get time, as we never get time to answer all the questions that we get in these events, but please follow up and speak to Miriam if you have a requirement or if you have further questions. Thank you for another wonderful presentation, Miriam. As always, as I said in my introduction, I think it's a time now more than ever that people need to be talking to real experts and getting genuine advice and information, rather than being spooked by the sensation in the media or dealing with some of the fake buyers agents that are out there. I'd just like to end with this question, and I'm hearing a lot of this, people saying, no, we're not going to buy now, we're going to wait because we think prices are going to fall. 2 years ago when COVID struck, the economists were forecasting prices were going to crash, and a lot of people decided we're going to wait. Oh. And a year later, they found that they had to pay 15 or 20% more for the same property. What would you advice be to people, just to end on this note, who have sort of got that kind of mindset that they're ready to buy, but they think maybe if they delay, they can get a better deal 6 months from now?
Yeah, and look, it's interesting. I come across that question all the time. When do you think the market's going to drop? And it's like, I don't have the answer to that. I don't have a crystal ball. If you're looking to time a market, that's usually if you've got a flip policy, get in, renovate, get out. That's where timing's important. And yes, it helps if you buy at the bottom of the cycle, but wherever you're buying, you want to take a medium to long-term approach. So whilst timing can be important, if you don't have a crystal ball and you can't tell me, let alone yourself, when the market's going to be at the right time for you to buy, then I can guarantee you will not buy and you will have shot yourself in the foot. So I know when COVID first started, I think March 2020, I was buying for a client at the time and there was such panic in the market because no one knew what was going on. I was still quite bullish in the market, and I remember buying one property $120,000 less than where we appraised it from a very nervous vendor on the day before the auction. And so it's really a case of understanding where the opportunities lie. And so long as you buy a high-performing investment grade property, regardless of when you buy it, it will tend to hold its value better in a downturn and it will be a first responder in an upturn. So think of it from that perspective.
Okay, I think that's a great note to end on in these times of uncertainty and disruption. Thank you, Miriam, for another wonderful presentation. Let's do it again soon.
Absolutely. Thanks for having me, Terry. Bye, everyone.
Bye.